So are you trying to figure out what makes a great investment property? Are you wondering if it's going to be location, property type, or price? Should you focus on cash flow or appreciation? Well, in this video, we're going to tell you the best way to invest using the second suite strategy that more than 250 of my clients have had success with in the last few years. Understanding the numbers involved is the most crucial component of a project. We're going to break down the step-by-step financials when it comes to second suite investing. If you're interested in the numbers that are part of building a long-term strategy for wealth in real estate, you definitely don't want to miss this. Hi everyone, this is Andy and welcome back for another video. Now, even though we're looking at this purely from the standpoint of an investment property, the principles also apply if you're adding a second suite to a home that you live in and want to rent out. At the end of the day, the value that is added to the property as well as the cash generated will be the same whether it's your own home or strictly an investment property. So let's dive right into it. Before we start, it would be really helpful if you can like this video and subscribe to this channel so that we can get more videos like this out to you and other folks. For many real estate investors, they think of three main factors when it comes to the financial returns for a property. The first is mortgage paydown. A portion of the rent that you receive will go towards the mortgage you owe on the property. That mortgage has a principal component and an interest component. The principal portion that is paid down increases the equity that you gain on the property. The second item is the holy grail for many real estate investors, which is cash flow. After you pay your mortgage and other expenses such as property taxes, insurance, and some other items, what you're left over with is cash flow. This has been harder to obtain in recent years because of the rising cost of real estate. And finally, we have market appreciation. You obviously want to purchase in a city or town with the greatest opportunity for value increase due to local factors driving the economy. There are also macroeconomic drivers that can push the market value higher, such as low interest rates and overall immigration levels to the country. Market appreciation has been the biggest driving factor of value in the past decade. So we have mortgage paydown, cash flow, and market appreciation. The one that's not talked about as much is forced appreciation. This is where you use your skills, knowledge, and sweat equity to forcibly increase the value of a property. There are many ways to do this. You can do this with a cosmetic interior renovation, improve the exterior curb appeal, or even add a rear addition to the home. How do we like to force appreciation? You guessed it, adding additional units. Not only does this add value to the property, it also helps to accelerate the cash flow component of your investment. And it's exactly why many homeowners and investors have taken advantage of this strategy in the past several years. So what I'm going to do now is illustrate what you can expect on an investment such as this with an actual case study from one of my clients, so you can see the numbers for yourself. Now, before we start, we want to let you know that these numbers can vary, and it's best to always be a bit more conservative and always have money set aside as a contingency. A contingency fund in a project is not a matter of if you're going to use it, it's a matter of what you're going to use it for. It might be for a critical item such as a furnace replacement, or it might be for a cosmetic upgrade that you decide to add on later. Now let's look at some of the numbers using a case study. Here's a property on the Hamilton Mountain about an hour away from downtown Toronto. My client purchased this property for $504,000 in 2020. She put in approximately $115,000 in renovations, including tax, which covered the expenses for both the second suite and the cosmetic upgrades for the main unit. Keep in mind this is actually quite a low cost because she managed the renovation herself, meaning she hired individual trades for each component of the renovation, rather than a general contractor or a project manager. This number can be up to 20 to 40% higher if she had brought in a general contractor. She ended up renting this home for $3,550 plus utilities, $1,900 for the main unit, and $1,650 for the lower unit. Now let's break down these numbers and see what we can expect, both from the cash flow as well as the reappraised value for purposes of selling or refinancing the property. The way we're going to do this is first look at the upfront purchase cost, which includes the down payment and closing costs for the house. Secondly, we're going to look at the costs during the renovation process, which includes the renovation itself, design and permit fees, and holding costs for the property. Thirdly, we're going to look at the costs associated with holding the property long-term, renting it out, and figuring out what the cash flow is going to be. And finally, we're going to try to determine the ARV, which is also known as the after repair value, in case you either wish to sell the property or you want to extract as much equity out to fund your next project. As a disclaimer, the numbers we show here are for a particular project and they may not encompass all aspects of a project that you're involved with. So be aware that your numbers are going to be different. So let's start with upfront purchase expenses. So at $504,000, a 20% down payment, which is what's needed for most investments, is going to be $100,800, and so our total mortgage amount is going to be $403,200. We have closing costs such as legal fees, title insurance, and appraisals, and land transfer taxes. We have all of these estimated at $9,000. So our total upfront purchase cost will be $109,800. Now let's look at the cost for the duration of the renovation. We're going to make an assumption that the renovation period is approximately 6 months. During that time period, we have holding costs for the property, which of course includes mortgage payments, insurance, property taxes, the cost of borrowing for the down payment, utilities. We have this estimated at $13,000. Then of course we have the renovation costs and design and permit fees. We have that estimated at $120,000. Again, this number is slightly low because my client was able to self-manage a lot of the work. So in this case here, we essentially needed roughly $242,000 of upfront capital before we can expect to start gaining any profit from rent. So let's fast forward 6 months and now look at the numbers if we are to rent the home and what we can expect for cash flow. We've completed the renovation and are now ready to reap the rewards of all of this effort. During this time, of course, we have gained some mortgage pay down and hopefully some market appreciation as well as forced appreciation. The rental income we received for both units, as mentioned earlier, is $3,550, which is our net operating income. The tenants will be paying all the utility costs. Our expenses include the mortgage payments, insurance, property taxes, and the interest for the cost to borrow the funds and for the purchase and renovation. We also like to include amount for vacancy, property management, maintaining the property. Remember, in our example, we have no utility costs as the tenants are paying for all of those themselves. So our net operating expenses is roughly $3,050. So the cash flow is our net operating income of $3,550 minus our net operating expense of $3,050, leaving us a monthly cash flow of $500. Not too shabby. Remember, cash flow is just one part of our gains. Long-term wealth is created by combining cash flow with the other items mentioned, which includes mortgage paydown, market, and forced appreciation. Now we're going to go one step further and try to figure out what the ARV or after repair value is going to be after the renovation is completed. You might want to know this because you may be interested in selling your property. Many of our clients don't sell immediately after renovations, and I generally don't recommend selling either because there's a lot of risk associated with a conversion project such as this, since it's so capital intensive, and not to mention the potential higher taxes since there's higher likelihood this is looked at as income rather than as an investment. Of course, talk to your accountant for more information on this. Most of our clients hang on to the property long term. More often, trying to determine the ARV is more so to figure out a way to refinance a property in order to extract equity so that you can work on the next project. So even then, it may not be the best time to try to extract value immediately after your renovation. You may want to wait, give it a year before doing a refinance. Now, once you've completed the project, trying to determine the value is as simple as getting it appraised. However, you may want to run some figures before you even begin a project because you may have plans for future projects. So when I'm running my numbers before starting a project, I may make an assumption that I will do a refinance about a year from purchase. That'll give me plenty of time to ensure that everything is completed. Usually what I like to do is take the value of the property at purchase, add in the cost to renovate, increase the value by 5% for forced appreciation as a result of adding in the legal unit, and of course, renovating the property to make it very appealing. Some may not agree with this number, but I feel it works for me and is relatively conservative. In our case, the house at $504,000 plus the renovation at $120,000 is $624,000. I multiply that by 5% and have a value of $655,200. So the market appreciation, we'll take a look at the current year-over-year returns for same type of property in that market. And also to be a little bit more conservative, I'm going to divide that by half. For example, if that market has gone up 10% from the same time in the previous year, I'll take 5%. So in our case, $655,000 multiply that by 5% is roughly $688,000. Assuming we're able to get the lender to appraise at that value, we may be able to extract out 80% of this, which is $550,000, minus the original mortgage, roughly $400,000, giving us $150,000. This is slightly more than our renovation cost, so not bad. That will allow you to start thinking about putting this and perhaps some other funds that you have together for your next project. Don't expect that you're going to be able to extract out 100% of your initial investment. If that happens due to market conditions, think of it as a bonus rather than something to be expected. Now, if you're thinking about selling the house after a year, a value of $688,000 means that you're going to incur about $40,000 in expenses for realtor and closing costs, which leaves you with $648,000. If you had an initial purchase of $504,000 plus initial holding and renovation costs of $135,000, you spent $639,000. You may have gained $13,000 in cash flow and mortgage paydown during that year, bringing your total spent down to $626,000. If you sell, your profit at the end is only going to be $22,000 in our example here. That's a lot of work for $22,000. I don't think it's worth it, and it's very risky. This is why a majority of homeowners and investors who add in legal second suites tend to hold the property longer term rather than sell their property immediately. This is what makes the most sense in a majority of cases. You might be better off hanging onto the property and taking equity from it to work on your next investment. Remember, the more transactions in and out of a property will trigger higher taxes and higher transaction fees. Long-term holding is the name of the game. So this is just a quick look at some of the numbers you can expect if you were to do a second suite investment. Obviously, we use the numbers from an actual case study. Your numbers may be different or similar. The difference here may be the lower cost to renovate due to our client managing the project herself. What we have discussed here is just the tip of the iceberg. We discussed this in much more detail in our second suite's profit formula masterclass, where we dive deep into the costs, expenses, revenue, and profit for a project. Additionally, we get into financing the ideal property, design and permit process, the renovations, value extraction, and much, much more. If you're interested, we recommend that you check it out at www.suiteeditionspro.com.
Thanks very much for watching this video. We'll be coming out with more content like this to help you with your project, so be sure to subscribe to this channel. And if you can click that like button, it would really help us out. If you don't already have a copy of our 2 free guides, the 8-point checklist and Legal Second Suites, a beginner's guide, hop on over to suiteeditions.com and download them right away to get started on creating better homes, building greater communities, and generating lasting wealth. We'll see you soon.